What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team ranked number one on Wall Street in the All-America Institutional Investor Research Survey. Emily, welcome to the podcast. And Jay Glickson, welcome to the podcast. Just for our listeners, Jay, Emily, and I have worked together for about 15 years. Jay works on the institutional side of macro sales. Jay and I worked together back we started working together, Jay, what was it, 2007 when I joined ISI. Yeah. We were there in my formative years through the GFC, et cetera. And then we worked together all throughout the years at Cornerstone Macro. And now we're at Piper Sandler. So Jay, really psyched. You're a salesperson that I've known probably the longest, and you and I market travel together. So you know a lot about what our views are and the pushback you're getting from clients. You just said something earlier as we were introing the call, talking about what we're going to discuss, that the whole world has changed in the last 3 days. So let's dig into that. What are you hearing from clients and what's the pushback you're getting? Let's just start there.
It's wild. You and I have worked together for 15 years. I've actually been part of the macro group for about 25 years now. And this is almost no other time that I've experienced where we are in the early phases here of what feels like a strong macro recovery. And then we have all of a sudden, you got to look to your left, look to your right, trying to figure out what are the risks that are right in front of me. And this week in particular is one of the most incredible experiences that I've witnessed. Monday night, I was at a dinner with about 15 to 20 clients. There was not really a major risk in front of us. This idea that fundamentally the macro backdrop was continuing to improve, and this idea of rotation was not just understood, but it was embraced, and if anything, demonstrating why that will only accelerate moving forward. And again, I remind you, this was Monday night. Now come, call it Wednesday, the world is all of a sudden reshifted. And so what seemed like a world of no risk, all of a sudden has become only risk. And so I've really never seen such a sentiment shift like this so dramatically without any real specific catalyst to make this happen. So it's interesting over this week in particular, when this happens, people reach out to you. What are you hearing? Yeah. What are you picking up? So it feels like when you're in this kind of state, people want to, again, group think and talk a little bit out loud. And a lot of times when you do that, there's no answers. I can't say I'm providing an answer for you today in terms of what we're thinking. I think what you guys do in particular in our macro platform in general is try to keep people stable when things are unstable. And so what we can do is talk to what we know, and then we can step back and deal with the real-time impacts of what's going on within the market. So it's been a wild week, and macro matters, but right now it feels like a bit more outside variables are driving a lot of what we typically are discussing.
Jay, I think it's so interesting you talked about how this has been the major shift in sentiment this week. I was just looking at a chart of the market, and given how much sentiment has shifted, it was surprising to see that we're down just a couple percent from the all-time highs. Obviously now it's software that's down 20%. That's really what people are focused on and what people are freaked out about. But looking at a chart of the broader market, we're only down very slightly. And so I think it is really interesting that sentiment has shifted so dramatically and the risk has shifted so dramatically. Usually it takes, I would think, and what we've seen historically is it takes a bigger move than that. Would you agree with that, Michael? This has been a big shift off of just a narrower part of the market that's really getting hit hard.
Really, up until Thursday, a lot of the negatives were canceled out by the positives. You had this rotation taking place, so the overall market really wasn't showing much volatility and was quietly grinding higher. And now the fear has broadened out. The good news has broadened out, but now also the fear has broadened out, and that collision has now certainly hit the tape. In the middle of the week, we heard another bit of news related to AI disrupting brokers and wealth managers. There's an ETF that I was keeping an eye on. I think it was Wednesday. I think it had record volume. Things like Charles Schwab and names like that, LPL, got hit really hard. So it does seem that investors are now on the hunt to either avoid what's going to be potentially disrupted next or looking to short those names because clearly that's what is top of mind right now on the investor's mindset. And it's amazing. You're right. Like it just in a couple of days, there's nothing like price changes to change narrative. We hear that all the time. Jay, I'm curious at the dinner you were at on Monday, and just more broadly speaking, you speak to a lot of institutional investors. You speak to all institutional investors, but it's mixed between long-only institutions and a bunch of much more short-term focused, long-short hedge funds. Where do you hear the most anxiety? Is there any dispersion in sentiment? Are long-only managers taking a longer perspective?
It's a really good question. And I think, to be honest with you, a lot of investors right now are actually trying to figure that out. You want to take a longer term perspective in terms of what you think fundamentally is the right place to be. But when you get these kind of, call it violent moves within the market, it seems to just real quickly create this reassessment. I've struggled over the last several months trying to find a bear to talk to pretty consistently. A couple of the bears have shown up this week and told me this has been my fear. These are some of the problems and concerns that I've been worried about and I think are just beginning. So I'm hearing a little bit more of that voice from people that were a bit more cautious in this kind of, call it euphoric market that feels like we were heading towards. But that still is a minority relative to, I think, the majority of what our clients are thinking about. So the way I'm answering the question would be that, like, I can't separate between hedge fund and long only. I can say that I think the bias is that fundamentally people are still pretty constructive, still buy into this further rotation and broadening out of the market and also the economy, and are just temporarily somewhat handcuffed on how to play these near-term negative impacts to the market. Because I do think guys also do recognize and appreciate the magnitude of positive that can come out of this AI change. Productivity enhancement in particular is certainly something that's going to help much of our companies that we are associated with, but it's hard to position for that at this moment when things around you are falling apart. It's a little bit of, I won't say confusion. I don't get a sense that there's a lot of like market reaction change where people are immediately adjusting a portfolio based on what's going on at this moment. Unfortunately, you're reacting to what's going on around you.
Yeah. I think what makes it difficult too, and we were talking about this in our morning meeting today, that there's really nothing to quantitatively to measure in terms of catalyst of what's going on. And what I mean by that, typically markets go down because of interest rates going up or unemployment moving sharply higher. So you could see the data and you can react to it. And then you could also know if that data starts to improve and go the other way, rates start to come down, unemployment starts to come down, we know that's a typical catalyst for a market rebound. It feels today a little bit like, I'll make two parallels, and I want to curious to hear what you think about this. One, it feels a little bit like tariffs, where there was no data to look at on that. Everyone was just listening to President Trump, and it turned out what put a bottom of the market was literally his rhetoric turning positive, which was the pause, of course. So I think back then investors were very much just reacting to every headline. The other analog I'm thinking is, I remember a few years ago, maybe it's 2, maybe 3 years ago, where investors were really bearish on energy and oil specifically. And the narrative was that terminal oil, value of oil prices is going to zero, and the energy renaissance is on its way, and we're not going to need oil. So all of these energy companies are ultimately their terminal value is zero. And that certainly seems to have changed as investors have realized that we're going to need oil for a lot longer than people initially thought. So I wonder if, what you think of that in terms of what's going on today with employment. Sure, we're going to see creative destruction and people that are going to be replaced by AI, but how broad is that going to be, and really how long is that going to take? Because the market's reacting like that's happening now, and there's not a ton of evidence in the data that is really true. There's certainly anecdotes, and it is happening, but certainly not broadly.
I hear you loudly on that. And one pushback I would maybe say would be that if I think about tariffs and Liberation Day, it's more, you can you can quantify it a lot easier, more tangibly, I think at times more so than this kind of more subjective or unknown that we are in at this moment. I understand that tariffs are still in an unknown environment, so you can't necessarily quantify it, but you could put a number there and you could put a high or you could put a low there, but you can start to somewhat build that into your process. And then that settled down and people understood that number, and then therefore they repriced themselves. The challenge with using today at this moment and these concerns that we're dealing with real time right now is that it's harder to quantify that, I think, or quantify that specifically at this moment. And so right now we're just repricing and punishing where you think could be a risk, think a problem is potentially going to unfold in front of you. And so that's harder to, I think, fully discount. And that will settle down. And then I think when that settles down, all right, there's going to be some losers here that should be repriced lower. And then the market will start again reshifting to, in this broadening out theme that we talk about, who are the winners and how is this ultimately going to continue to enhance and broaden breadth of market and also economy. But I still think it's just unclear at this very moment. And therefore, it's going to be a little kind of choppy, to say the least, it feels like, until we get more comfortable.
I'm wondering, Michael, if you have any sense of what it would take as far as what could get people to be more comfortable. Obviously, a lot of these things are going to take a long time to play out. It could be potentially volatile, and some areas could be choppy for a while, but wondering shorter term, if you have any sense of what it could take that could help calm some of these short-term fears that people are now experiencing.
Yeah, so I was actually just looking at the NASDAQ, and in the context of the conversation we were just having about tariffs, right before we saw tariffs, the PE of the Russell 1000 Growth Index was at about 30, and it fell about 9 points into Liberation Day. So we had a 9 PE point decline in the Russell 1000 Growth. Today, we were also at about 30 4 months ago, and we're down to 25. So we've already seen the market reprice a little bit more than half as much as we did during the tariff scare. Now that seemed like that was a lot scarier and certainly a lot more near term. We know those tariffs kicked in and they were going to kick in, whereas the duration of this story is far more uncertain and certainly longer term, at least we think, but perhaps the timing of that. And I think that's what's changed, Jay, is that the people thought that, oh, we've got a couple years or many years before this really starts to impact things. And this week we got a bunch of posts on X and new products announced by Claude that, wow, this is happening a lot faster than we initially thought. I guess, Emily, it's hard to answer that question because, again, there's nothing quantitative we can point to. I can't say once rates stop going up, like in 2023, or once oil bottoms, or once the economy bottoms. So I would say, I don't know if it's good news, but I guess we've been telling investors since September to really start moving away from the AI trade and expensive stocks, not because we were necessarily fearful of this, but because we're starting to see the economy broaden out. And so we've been recommending value strategies. Now, one of the benefits of a value strategy at a time of multiple compression, particularly when it's compressing on expensive stocks, is that you avoid a lot of those names. I would say cyclically, I wouldn't necessarily be recommending investors try to jump in and buy the dip on these names. Sure, there'll be short-term trading opportunities, but I think our view is that for the next 12 to 18 months, investors will continue to gravitate towards areas of the economy that are cyclically improving, and many of those areas are more likely to benefit from AI rather than be disrupted by AI. Yes, I'd love to have a great simple answer, but I would just generally say those are names expensive names to avoid this year, and the S&P index is not the index to own this year, just given the concentration.
I was going to say, Cantro, is one of the things I like to say, which is, as I keep saying to you, I go, don't buy the dip, buy the rotation. And I don't think that's changed at this moment. And I think, again, that theme is going to play out. The challenge we've had over the last while that you guys have highlighted really was that there really has not been really any macro risk being priced into the market. And to me, when you're at levels, valuations are where we've been and kind of market returns that we've experienced over the last few years, when you tell me there's no market risk, that becomes your biggest risk.
Yep.
And so you start to put or start trying to think of what are the risks that I should be concerned about. And I can backtrack a few weeks ago. I was with our energy analyst, Jan Stewart, and having an interesting commodity dinner. And the entire conversation was about the debasement trade. And at that time, we were seeing precious metals continuing to soar, and it was a weakening dollar thesis that was pushing asset classes higher that didn't make a lot of sense. That corrected only about a week or two ago. And now all of a sudden, all right, we've now shifted to the next new macro risk, which is AI disruption, job destruction, et cetera. And so when you tell me there's no risk in the market, the wall of worry gets higher.
Yep.
And so people are looking for that right now. I think fundamentally, they still believe in the strength of what is improving, but they're not confident that they can necessarily position at this moment until they see more evidence that it has improved. And so the wall of worry will be in front of them until they get that confidence.
Michael, I just wanted to jump back to what you were talking about before with regards to value stocks and avoiding the most expensive stocks. I guess if we are going to be in a period where there's potentially all this fear around AI disruption and the most expensive stocks getting hit, would you say we've seen a big move in some of the more defensive sectors recently? Would you say that it is a better risk reward at this point to be looking for value as opposed to defense? Or do you think that this is a time that investors should be adding more defense to their portfolio?
Yeah, that's a good question. To Jay's point about credit spreads being at record lows, which is the measure when we think about how much macro risk is priced into markets. So that in it itself is not a reason to be bearish, because again, I think we had a macro backdrop that warranted very low credit spreads and elevated valuations. And what's making PEs go down today is not a real change in that macro backdrop, which again, is inflation ticking up? No. If anything, the AI story is disinflationary or deflationary, and that's certainly part of the positive that no one's thinking about right now. Is unemployment rising? There's fear of employment down the road, but certainly the employment data has gotten better in the last few months. And ironically, people are more worried about employment today. So it does make sense to have some exposure to defense, certainly more this year than you had in 25, 24, and 23, when we had elevated credit spreads that had room to come down. And in a way now, I'd have to acknowledge that the outlook for risk is definitely asymmetric. And you should probably be at least market weight some of the defensive, lower volatile names in the market. And I think you're seeing that. I don't think investors have gotten super bearish and super defensive, but they've clearly moved to more short duration assets. Like the best factor, I think you were highlighting this week, Emily, dividend yield is one of the best factors in the market this year. That's a very short duration value factor. And some of the worst performing names are, again, some of the long-term momentum names and the longer duration growth names that are expensive. High valuations have gotten hit pretty hard. So people used to call that chicken bullish, but I think it makes sense in this backdrop. Plus, I would also say that in a market decline here, a year ago and 2 years ago, the stocks that were really most at risk back then, I would argue, were the cheaper, more cyclical names, because markets were going down in the last few years more often because of inflation scares and rates moving higher at a time where the fundamentals of the global economy and the breadth of the economy were very weak. Today, though, that has changed. There is a improving fundamental backdrop, which perhaps makes the stocks most at risk, especially given the current risks we're talking about, really now the expensive names. So I think mixing a little bit of defense and low beta, low some of the names like Coca-Cola, Campbell's Soup, Costco, which is not cheap, but it's certainly stable. That's the type of stuff that you've seen investors move into. But making a big bet on that is really just making a big bearish call. And certainly that's not our base case here. And it's going to be really hard to navigate a bearish outlook just based on all this AI disruption with really not much tangible evidence of it hitting near-term fundamentals while we have a improving backdrop taking place in manufacturing activity and cyclical parts of the global economy. So it makes more sense to me, because we're seeing improving earnings estimates in areas that haven't seen it in 3 years, to have much more exposure to that kind of stuff. And that helps you avoid a lot of the expensive names with a side of defense.
One other question. We spent so much of the last couple of years, investors have been razor focused on rates. And this week we've seen a pretty significant decline in rates. And it seems as though that's been pushed to the side. Those people aren't really focused on that this week, but it has been a pretty significant move. What do you think is the narrative going forward as far as what happens with rates and how this influences whole framework, the market going forward?
Yeah, actually, I want to pass that to Jay, because I know he speaks, again, he speaks to tons of clients that he knows very well, so he can get the feel for how their outlook is changing. And Jay, the last few years, the deficit, the debasement of the dollar, and higher rates have probably been front and center more often than not as the risk to equities. And now we're sitting here with the 10-year in the US below 4.1 and rallying. Decent inflation report today. We're at 405 this morning, but it's not helping lift equity. Is that still a risk you're hearing about, or just not in the last week?
No, it's still a big risk, but it's kind of like, why are rates falling at this moment? And that does not give comfort, I think, immediately to investors. And so I do think it's the most important variable that you continue to highlight is lower rates, or you've been talking a lot about a sweet spot rates could trade in, Goldilocks kind of level, whether it was 4 and change to 450-ish tops. It could be a positive for overall markets. We're on the lower end of that band at this moment, and people are not excited about it because they're looking at it more negatively, I think, at this point.
Yeah.
So to me, at the end of the day, lower rates in terms of its impact ultimately on housing, which is how I think a lot of investors do think about it, still comes back to jobs. And so if rates are getting lower because people are nervous about growth expectations and economic disruption and therefore job loss, that then becomes more of a negative at this moment in terms of housing doesn't do better if people are nervous about losing their job. And so that is still on the forefront, I think, of a lot of investors, is that the labor market risk is being amplified at this time. And maybe that's being a bit reflected within rates today. And that's a greater concern at this moment, instead of a potential catalyst to help broader companies do better as a result of rates going lower. Today, it's more about, am I going to have a job? Can I afford a mortgage? Do I want to do that? And that's, I think, holding a lot of consumers back, and therefore giving investors a little bit of pause to really press, let's say, some of these early cycle names, some of these consumer discretionary names, maybe in particular. So that's a lot of conversation in that regards.
I want to end on a positive note here. So as we look here today, Friday morning, the market's selling off after the CPI report, 10 years down to 405. Home building stocks are up 1%. I don't think we're going to get answers to all these existential questions that are being posed by AI anytime soon. I think we have a really fast news cycle and a myopic investor base. So something will help this settle out, I believe, whether it's a good jobs data point or the claims data continue to remain low, or we continue to hear from small businesses that they're getting more optimistic and their hiring plans are increasing, which has been taking place over the last 6 or 8 months, which again is a data point to debunk some of the risk in the near term to employment. We'll see. But if we come out of this sell-off here and we get a nasty hit to equities, but it provides us a mortgage rate that has a 5 handle on it, which I got to think we're pretty close to that right now. Certainly that could help to put a floor in the broad sentiment outlook for the economy. And if that translates into better housing data and further supports this rotation, which lower rates do, hopefully that could be something that settles this out. So again, I think a lot of the negative we're seeing, the silver lining of it is that rates are coming down. And we know throughout history that can be, and always is, at some point, a major factor that provides stabilization. I think at the end of the day, when you're in this environment, where there's growing uncertainty, and that's ultimately what it is. It's uncertainty. It's just a different type of uncertainty than we had a year ago. You just have to rely and go back to your framework and to center yourself and keep your feet on the floor. And our framework is certainly very unanimously pointing to a broadening out of the economy. And I don't see near-term job destruction that is going to stop that in the economy. And the economy is not always the market. And we're seeing that now as the market gets repriced. But I think we have a nice runway ahead of us for a lot of cyclical areas of the economy. And if some of the AI concerns result in lower rates, then that becomes a benefit to rate sensitives and the housing sector even further. So I'm going to take away from this a more positive tone and try to think big picture and focus on the things that we can understand and quantify. And I think sometimes you just have to listen to the market, but also follow a framework. Thanks, Jay. I'm glad we got you on here. I feel like I had to pull your ear to join us, but thanks. It's a pleasure having you as the first macro salesperson on the podcast.
Congratulations.
No, appreciate it. Thank you, guys.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.